Ladies and gentlemen, welcome back to the channel. We have a lot to get into in a very short amount of time. Now, I do want to go over what's happening today, what's going to happen in after hours, but also a very interesting thing that I seen on CNBC yesterday. And it's something that I think you really need to understand that could be really good and really bad. Jeffrey Gundlach thinks this could be the next financial crisis and could cause the Fed to basically cut rates down to near zero again. So, and I do think it has, I should say from the start of this video, a scary high probability of actually being correct. So I'm going to give you the synopsis of this, the quick version, and tell you guys kind of what I'm doing as well with my portfolio. So hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Let's go ahead and get into it, guys. Share this video with a friend that needs to hear it as well. So essentially, I'm going to play like the 45-second clip of what Jeffrey Gundlach said, but I really just want to give you a synopsis of what he's saying here. So basically what you're about to listen to, and just type in YouTube like Jeffrey Gundlach, CNBC, watch the whole thing. It's like 7 minutes long. Highly recommend you guys do. It's been a long time since I have found something so realistic and probably accurate. So Jeffrey Gundlach says basically the Fed, like the Fed said yesterday, they have no control on long duration yields. Your 10-year treasury yield has went from about 3.3% to 5% since May. The Fed has raised rates twice. That means the yield curve, the 10-year treasury, has actually went up like 1.5 to 1.7%. It's actually went up like 1% to 1.2% on top of what the Fed has done. That's because the treasury is spending money like they're drunk to support the government. They keep issuing bonds. There's a supply and demand dynamic that's really imbalanced right now. People obviously don't want to own treasuries, but the treasury continues to issue more and more treasuries, a record amount of treasuries. So Jeffrey Gundlach is saying, if we start to go into a recession, like he thinks in the beginning of 2024, if the Fed wants to give us a 25, 50 basis point rate cut, the long duration yields are not going to react to that. He says they might initially, but they will bounce right back. And that's because the Treasury is issuing treasuries like they are drunk. So what that means is you will probably need to see like 2% rate cuts to move the long duration treasuries. The Fed controls the 2-year, the 3-month, the 6-month, the 1-year, you know, the short duration. The 10-year though, the Fed does not really control that at all. They try to communicate to that. They can have an influence on that, but they don't control it. So that's why the Fed kind of made those comments that they did yesterday, right? The Fed, for the first time in this whole situation, acknowledged that lower stocks, a higher US dollar, and long duration treasuries can influence the rate path going ahead. The Fed basically said if stocks fall and treasuries stay high and the dollar stays high, we might cut rates a lot sooner than what you guys are thinking right now. That's because if stocks fall, you're putting restriction on the economy. If treasuries stay high, that puts restriction on the economy. If the dollar stays high, that puts restriction on the economy. And stocks simply falling, you know, is not leading to investors buying the bonds. Typically, if stocks start to do poorly, investors start to get fearful and they start to buy the treasuries, thus driving down yields. You could be in a situation where you're just getting drained from everywhere. The dollar's high, bonds are high, stocks start to crash, and nothing reacts. And you get no kind of, you know, foot on the brake, so to speak. And the Fed, well, they're saying they might cut rates a lot sooner if stocks fall. So I think this is, you know, kind of one of those good and bad things, right? If the Fed cannot control long duration assets, if we do go into recession, that means rates are going to go low and they're going to go low quickly. On the other hand, that probably puts the economy in not such a great position. If that is ultimately what happens, that probably hurts stocks for a while here. It's hard to say. I'll go ahead and run the clip, and then we'll come back and get into everything else you need to know on the day with AMC stock as well as the broader markets.
I don't know, Josh. I mean, there's some logic to that. I think that the wealthy people, they have savings. They have wealth by definition. And so them getting a higher interest rate of 6% instead of 2%, I'm not really sure that motivates spending exactly. I think it just makes them wealthier. So I don't really know about that. I just think that all of those unusual things that happen that you correctly point out, I think when you drop $4.5 trillion of free money into an economy, one should not be careful about predicting that's going to have outsized consequences. So what I think everybody missed here is what we had initially with all that stimulus was a massive boom in consumption of durables and that sort of the manufacturing part of the economy. And then what people missed is it then turned into a services economy because there was all this pent-up demand for services and travel and leisure and all that stuff. And I feel like that's wearing off at this point in time. And so I'm not really sure that those conditions are going to endure much longer. And I say higher for longer. I'm going to go back to my number one point that I started this segment on. And that is higher for longer means we have a massive interest expense problem in this country that is going to be, I believe, the next financial crisis. And so that's what I'm more focused on rather than some Scrooge McDuck having more money in his vault.
What about the idea of cash being king? I've had people come on, the network this week and suggest that is actually the best place to be. That's where the lowest amount of risk is right now. What amount of cash would you have in a portfolio now?
I don't like cash because I think that your interest rate, which is very attractive presently, may decline quite substantially next year. So I would rather be in something that's about 2 to 3 years. So at least you're getting that yield that I talked about around 8%. At least you're going to get that for more than 6 months. T-bill and chill, you can buy the 6-month T-bill and get 5.5 and spend that way for a long time now. The rate is no longer going higher. It's now starting to potentially decline. So I don't think you want to be in cash. The shape of the yield curve suggests that the 2024 will see the Fed cut rates by about 50 or maybe 50 basis points or maybe 5/8%. That's the one thing that I think will not happen. I think that either there are going to be rates will stay high for longer, which is not my base case, but I acknowledge that's a possibility. But if the economy rolls over as I expect, the Fed is not going to cut rates 50 basis points. They're going to cut rates 200 basis points. And that's what's wrong with the cash strategy.
The other thing I heard the chair say today that I frankly don't recall him saying, certainly not at a meeting, was when he was addressing the idea of what the backup in rates has done, where financial conditions have gone. He said they're attentive to all of that. He did mention a stronger dollar being an influence on future rate decisions. And you know what else he said, Jeffrey, which sort of struck me at that moment? Lower equity prices. He actually brought that into the mix today as being a thing that could influence their future rate decisions, that if something happened in the stock market, that could be a powerful influence for the Fed. What's your take on that?
Well, what's new here? I mean, that's always the case. Remember 2018, where we had that bear market in the fourth quarter of 2018 because the Fed said that they were on autopilot for raising rates and doing quantitative tightening, and the stock market dropped 20% in like four or 5 weeks. The junk bond market seized up. There was no issuance for weeks on end, and suddenly the Fed started cutting rates and abandoned all of their rhetoric. So I believe deeply that when the recession comes, you're going to see a bond rally. It may be accompanied with a stock rally initially, but they're going to reverse because of the policies. And then we'll see what happens when the stock market starts to drop in earnest with what would be surprisingly potentially a weak economy with rising bond yields after their initial decline.
So let's start with AMC. AMC is up about 5% today, trading at $10.50. Calls, you do have volume of 68% today. Puts at about 32%. Open interest on the call side is 63.66%. Puts is 36.4%. 36.34%. If you look at the option activity, you have seen 2 orders totaling about $71,000 with a positive order value of 100%. Put to call ratio continues to fall at 0.68%. This is insanely bullish. I mean, this is exactly what you want to see if you are someone that is looking forward to a rally. Now, if we look at the Ortex data here, keep in mind, take this with a big grain of salt. You have short interest of free float at 6.42%, $127.37 million worth of short positions. Days to cover 0.64, short interest of 12.7 million shares. Shares out on loan 14.96 million shares. Cost to borrow 1.23, utilization of 34.78, and a short score of 51.32 out of 100. So not the most exciting data, but just keep in mind, take it with a big grain of salt, because I would go out on a limb and say these numbers are not true, and you know they're obviously wrong. These numbers are a lot higher. Now, we really don't have any company specific news for AMC stock. You're actually seeing AMC stock had its best 2-day stretch in multiple weeks, and if you go back, you know, further than that, it's been a long time since AMC stock has actually performed this well. Now, if you look at the charts here, the RSI is at 53.58. And if you specifically look at the candles, what we've done recently, the fact you're above that 50-day moving average, you're basically hitting the same high that you just hit over the past couple of days here. You're at $10.62. If you start to break above about $10.80, then you get into a, you know, potentially much larger move higher from there. That's where you could start to break out above 15, above 20, you know, potentially even to that 100-day moving average at $24.18, or that 200-day moving average at $35.30 per share. That could get exciting, and that could get exciting very quickly. Now, the RSI supports the fact that you're probably going to go higher. The MACD is almost in positive territory. The MACD is negative 0.26 on the yellow line, the signal line, or the MACD line. The signal line, the blue line, is negative 0.62. So you're looking really dang good for AMC. I don't think you could be in a better position right now heading into what could be a potential rally. Now, things in the marketplace are going to have an effect on AMC and obviously the markets. Today, in after hours, you're going to have Apple, Block, DraftKings, Carvana, Fortinet, Starbucks, Coinbase, Pioneer, Cloudflare, Fidus. I actually only have one trade besides some old free trades on Apple. It's for Fortinet. I think Fortinet has an interesting risk-reward dynamic going on now, and I did make a trade on it. So if you guys want to come see that, check that out. Link down below in the description of this video. I send out all of my trade alerts. It's like a $180 trade. If we seen something similar to what happened last quarter, you would make like $6,000. And the expectations for next quarter guidance are like insane. Fortinet's expected to report 36 cents of EPS this quarter, but over $1.30 of EPS for next quarter. If that guidance does not come in around that range, yeah, it could be, you know, a bad situation for Fortinet. So that's something I think makes a little bit of sense on a risk to reward basis. Obviously not financial advice. Do what you guys want to do, but that's a little bit of insight on why I'm making that trade. Nonetheless, we are going to have some big economic data as well coming out tomorrow, which I think this is going to be more important than Apple earnings, but Apple earnings will still be, you know, very, very important. So tomorrow you're going to be getting, and we'll go over this a little bit more in the next video as well, but non-farm payrolls for October, you're expecting 180,000. Who knows? I don't know where that number is going to come in, but that's the expectations. Hopefully lower. That would push the probabilities of rate cuts coming a lot sooner, and that would have a positive impact on our markets, I would imagine, as long as it's not too low. If it's like 50,000 job ads, investors are not exactly going to like that. The unemployment rate expected at 3.8%. Again, I don't know if that's going to go higher, but this would be the third month in a row you're sitting at 3.8%. So those are really the big things we have going for us here in the marketplace. That's really what you need to know in regards to, you know, AMC stock and what's going on. If you look at these Stonko tracker data, today is Thursday, tomorrow is Friday. So you do have out the money calls of about 51,000, in the money calls of 28,000, in the money puts at 1,500, out the money puts at 43,000. The calls are just dominating, as you've seen from the beginning of this video with the option activity. I think it's only a matter of time, could be just days away from seeing a massive breakout for AMC stock. So we'll keep you guys informed. We'll keep you guys posted on anything that changes, anything that happens that you need to know on AMC stock, as well as the broader markets. Hit the like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.